Hello everyone, welcome back to the channel. Today's video is going to be my 2023 introductory guide to pensions for beginners. This is the final installment in my series of 2023 guides that I've been releasing to provide you with clear, concise and reliable information that will set you up for investing success in the decades to come. In this guide, we're going to talk about what pensions are, why pensions are so important, what happens to your money when it's in a pension, how you go about putting money into a pension, and the tax benefits of pensions themselves. So as always, let's start off with the obvious question. What is a pension? There are actually two formal definitions of the word pension on Google. The first is a regular payment made by the state to people of or above the official retirement age and to some widows and disabled people. The second is a regular payment made during a person's retirement from an investment fund to which that person or their employer has contributed during their working life. Both of these definitions deal with completely separate things, but yet both are technically correct. This is why I don't like the word pension. I think it has a reputation of being a very ambiguous term. Everyone is aware of the word pension, but not many can actually give you a formal definition, and for those who can, their definitions will likely differ from one another. I think a big part of the reason why there's so much confusion around pensions is because the word itself is used to describe both the process of saving for retirement and the act of receiving money in retirement. Two separate things altogether. So instead of defining what a pension is and putting one label on it, I'm instead going to tell you what you should think about when you hear the word pension. The word pension refers to the money that you've put away for retirement over the course of your working life using one or many retirement accounts. In other words, your pension is your total savings for retirement that build up within designated retirement accounts. The reason why I'm specifically referring to the money within retirement accounts is because that's the money which will have reaped the rewards associated with being pension money. We'll talk more about those rewards later on. Technically, savings in a bank account, personal investments, or your family home aren't part of your pension. However, you will be living off of those assets in retirement in addition to your pension. That's the whole point of all of this. Having enough money and other assets on the day of your retirement so that you can continue to maintain your standard of living throughout your retired years. Because at that point, you won't have a salary coming in to cover the cost of living. So again, your pension is the total sum of money that you've saved during your working years using retirement accounts. That definition isn't technically correct, but it helps you to visualize what a pension is and how a pension is different to money in a bank account or investments in a brokerage account. The only difference is that your pension is contained within one or many retirement accounts, not bank accounts or brokerage accounts. In fact, if we got rid of the word pension and just replaced it with retirement account, it would make things a lot easier. So why are pensions important? I'll rephrase that. Why is it important to save money in retirement accounts? The long and short of it is that we, as Europeans, and indeed as a global society, are far behind where we need to be in terms of putting money away for retirement. It's estimated that some 20% of Europeans are on track for poverty or social exclusion as a result of insufficient retirement savings. This isn't a generational problem either. The situation isn't bad because millennials and Gen Z aren't saving enough for retirement. Our predecessors weren't experts at saving for retirement either. The situation is bad because we have an ever-aging population. People are living longer, and when you live longer, you spend more time in retirement. More time in retirement means more money is needed to pay for that retirement, more than previous generations would have required. For those of you wondering, won't my government look after me? It's time for a reality check. One of our formal definitions for the word pension was a regular payment made by the state to people of or above the official retirement age. That's effectively what you're talking about when you ask if your government will look after you. Are they going to provide me with a regular payment each week when I retire? As of right now, in most countries, the answer is yes. You're entitled to that payment provided you've paid enough social insurance tax over the course of your working life. That's how the system works. The workers of today pay social insurance tax from their wages to pay for the retirement of the retirees of today. They do so because A, they don't have a choice, but also B, they hope that they'll receive the same benefit in the future when they retire. Here's the issue. The number of people over the age of 65 is set to double by 2050. Meanwhile, birth rates are in decline. That translates into more retirees and less workers. Without enough workers, government won't be receiving enough social insurance tax payments to maintain the benefits that it pays to retirees. That leaves them with three options. Number one, increase the rate of social insurance tax to collect more tax from workers. This has the effect of sacrificing the financial well-being of workers today. Number two, increasing the age at which a retiree becomes entitled to state support. This has the effect of lengthening the time an individual has to spend working if they can't afford to retire independent of the state. And number three, reduce the benefits provided by the state. This has the effect of lowering the standard of living of retirees today. None of these options are good, but some or all of them must be introduced to save the system. The point I'm getting at here is that state support in retirement is far from guaranteed, and it shouldn't be relied upon. Hence, you need to take matters into your own hands. You need to actively put money away into retirement accounts for the benefit of your future retired self. Because if you don't, who will? So what happens to your money when you put it into a pension? Rephrase. What happens to your money when you put it into a retirement account? Well, it depends on the retirement account in question, but the concept is the same no matter what type of retirement account is available to you. Your money, once placed into the account, will or can be invested in what could be a wide range of different investment assets. Company stocks, government bonds, corporate bonds, real estate, cash, derivatives. There's lots of possibilities. What's the goal here? The goal is to invest in assets that will hopefully allow your money, and therefore your pension, to grow to such an amount that is satisfactory for the purposes of supporting your lifestyle in retirement. That's it. But Dan, that sounds exactly the same as what a brokerage account is used for. Right, you are. Just like how we use online brokerage accounts to invest in stocks on the stock market, we use retirement accounts to invest in various assets for retirement. It's the exact same concept. So a pension, a retirement account, isn't some mysterious void where your money goes until retirement. It's an account where your money is invested so that it can grow in value for the benefit of your future retired self. With that being said, how do you put money into a pension? Rephrase. How do you put money into a retirement account? For the vast majority of you watching, the way you put money into a retirement account is through your employer. Your employer will automatically deduct any contributions that you make to your retirement account from your weekly or monthly salary. This will make a lot more sense when we talk about the tax benefits associated with putting money into retirement accounts. Now, as an employee, you'll likely be in one of two scenarios when it comes to retirement accounts, and in some cases, you'll be in both scenarios. Scenario one is where your employer has what's known as an occupational pension scheme. Essentially, this just means that your employer has their own retirement account that both you and your fellow employees can put money into in order to save for retirement. If your employer has one of these schemes, it usually means that there's matching available. What is matching? Matching is where your employer will say, for every X euro that you put into your pension, we'll match it with X euro of our own. So as an example, if you were to put 500 euro into your retirement account each month, your employer might choose to match that with 500 euro of their own. That'd be 1,000 euro per month going towards your future self. This is free money that you're getting on top of your base salary for choosing to put money into the employer's retirement account, and it can really add up over many years where it's available. Scenario two is where your employer doesn't have their own occupational scheme. If that's the case, your employer is legally obliged, at least in Ireland, to facilitate the process of you investing into a retirement account. The employer will nominate a retirement account with one of the retirement account providers. Essentially, they pick a retirement account that all of their employees can invest into if they so choose. If you choose to put money towards this retirement account, your employer will automatically take the contribution from your salary and it will send it to the retirement account provider where it will be added to your account. Because Ireland doesn't yet have a system of pensions auto-enrollment, employers currently in 2023 are not obliged to contribute anything to their employee's pension, provided the employer doesn't offer an occupational scheme. This will change in 2024, where employers will be obliged to match employee contributions into the new auto-enrollment retirement accounts up to a certain limit. If you're watching this from another country, make sure you check your local rules to see if your employer is obliged to match some or all of the contributions you invest into a retirement account. Also, if you live in a country like the UK where auto-enrollment has existed for many years, you likely already have a pension and you might not know it. I did say there was a situation where you could have both scenario 1 and scenario 2 at the same time. That could happen where A, you've maximized the amount of money that you're permitted to put into your occupational scheme, and so your employer has advised you to invest any remaining excess in a separate nominated retirement account, or B, your employer has an occupational scheme but you can't access it until a certain age or a certain number of years service. So for the meantime, you have to use a separate nominated retirement account. That happened to me with my last employer. Once the money is in your account, the level of control you have over it will vary. If you're investing into an occupational scheme, there is a chance that your money will be invested by your employer on your behalf. In other words, they make the investment decisions. But many occupational schemes also allow employees to control what investments their money is invested into. With retirement accounts separate from your employer, you always have the ability to take full control over your investments. But if you don't want to, the provider of the account typically offers default investment options that make investments on your behalf, usually on the basis of your age. So what are the tax benefits of putting money into a retirement account? Why are there even tax benefits in the first place? Simple. The government really wants you to save and invest for retirement. Why wouldn't they? If you're able to sustain yourself in retirement, you'll be less of a burden on the system. That's just the simple fact of the matter. But how do you get people in their 20s, 30s, or 40s to put money into a retirement account that they won't be able to access until their 60s? One way is to have them pay less tax. Who doesn't want to pay less tax? The tax benefits of retirement account investing come in a three-pronged approach. You get tax benefits at 3 different stages: going into the account, in the account, and coming out of the account. When you put money into a retirement account, that money goes into the account before any income tax is charged on that portion of your salary. In Ireland, your employer handles all of the tax liabilities associated with your employment income. So when they're deducting your pension investments from your salary, they make sure that income tax is not charged on the portion of your salary that you're investing. That's why it makes sense for your employer to be involved in the pension investment process. So you're saving money on income tax by investing in your pension, and in Ireland, that can represent a tax saving of 40%, which represents an automatic investment gain of 67%. Extremely valuable. Once your money has been invested within the account, any gains or income that your investments earn you are also typically tax-free. This allows your pension investments to grow completely tax-free all the way up until your retirement. Finally, once you reach retirement, you'll typically be entitled to take out a portion of your money from your pension completely tax-free. There is nowhere else where these kinds of tax benefits can be obtained when investing. This makes pension investing extremely tax efficient. So that's everything you really need to know about pensions as a beginner. And that brings us to the end of our beginner's guide series, where we've covered an introduction to stock investing, brokerage accounts for beginners, ETFs for beginners, dividend stocks for beginners, and pensions for beginners. I hope you found these guides useful. If you did, you can show your support by leaving a like on the video and subscribing to the channel if you haven't already. If you have any questions on anything that we've covered in any of the guides, please do not hesitate to leave a comment down below and I will answer your question to the absolute best of my ability. Thank you very much for watching this series and I'll see you in the next one. Cheers.